If you read the latest strategy reports from top-tier investment banks, you will see a specific phrase repeating: deposit migration. We are watching trillions of dollars actively evacuate traditional, short-term cash accounts. For decades, the prevailing logic was simple. Keeping your wealth in a domestic cash account was the safest way to ensure steady, reliable growth. But the macroeconomic environment has shifted. Today, sitting on idle cash is an active liability. Analysts call this liquidity drag. When you combine sticky global inflation with a structural decline in interest rates, uninvested capital steadily loses its purchasing power. The speed of this value erosion now easily outpaces meager returns offered by standard bank accounts. Leaving money in a standard domestic account guarantees wealth destruction over time. To preserve its value, capital has to become restless. It has to move. To understand why these interest rates are locked in a downward trajectory, we have to look at China's strategy of building massive physical infrastructure. This chart plots China's investment share of GDP. It shows a steady plateau above 40% for 20 years, dwarfing other major economies. But that catch-up phase is over. Data projects a steep decline, pushing investment share down to 34% by 2035. Because China's capital stock to GDP ratio has now surpassed most developed nations, the overall rate of return on new physical capital is dropping. The national economy simply cannot generate high yields for domestic savers when the structural demand for massive capital investment is actively shrinking. Yet, even as this investment demand falls, Chinese citizens continue to maintain one of the highest domestic savings rates in the world. This creates a stark mathematical imbalance. A massive oversupply of capital is chasing a shrinking pool of high-yield investment opportunities. The result is permanent downward pressure on interest rates. At the same time, national policy is redirecting available credit. Funds previously flowing into the sprawling property sector are now strictly targeted at high-tech manufacturing. Traditional capital pools are effectively locked out. Faced with falling domestic yields and rising global inflation, these domestic savers are forced into an urgent search for yield. To escape the gravity well of low rates and avoid liquidity drag, capital is crossing borders to find reliable cross-cycle risk hedging. A vast portion of this restless money is flowing directly into Hong Kong's highly developed financial architecture. Specifically, it is moving into Hong Kong's multi-currency participating savings insurance policies. This diagram illustrates how these policies function. Capital enters a central hub and can seamlessly switch between US dollars, Hong Kong dollars, and renminbi, deploying into global assets to solve the domestic yield problem. Now, cross-border capital flow naturally faces regulatory scrutiny. However, recent reporting from UBS indicates that the sweeping crackdowns are specifically targeting illegal, unstructured outflows. The actual goal of these controls is to formalize legal corridors. The system actively rewards patient capital, long-term institutional investments operating within Hong Kong's transparent common law framework. Financial security no longer comes from passive hoarding in a domestic account. Protecting wealth against economic shifts requires building an active, legally resilient global architecture.